This is Larry Fink. He's the CEO of the biggest wealth management firm worldwide. In 2024, the company held $11.6 trillion in assets under management. That's more than the entire economies of Japan, Germany, and the UK combined. His investment decisions can move markets. Governments listen to him. When he speaks, the financial world listens. But what about you? You don't need to be a billionaire to manage and grow your wealth. The truth is, most people don't struggle with money because they don't earn enough. They struggle because they don't know how to manage it. In today's video, I'll show you 5 simple steps to take control of your finances, protect your wealth, and build a financially secure future. Mindset. The first thing you have to do is change how you think about money. Work, earn, spend, repeat. That sound familiar? Because this is the exact mindset that keeps you stuck in a cycle. Because you only make money while you work. Sure, you might have some savings on the side, but with inflation eating away at your money, you're actually losing value over time. See the problem? If you stop working, the money stops too. You're stuck trading your time for money. So how do you escape this? You need to make your money work for you. Rich people, they don't work for money. They make money work for them by buying assets that generate income, even while they sleep. For example, if you waste $300 a month on stuff you don't need and you invest that into the S&P 500, in 30 years, that could be worth over $447,000. And guess what? You didn't do anything extra. You just let your money grow over time. With that being said, there are 2 types of income. The first type of income is the earned income, meaning you trade your valuable time for money. However, what we want is passive income. Because passive income is money that works for you. This is money from things like stock dividends, rented properties, or treasury bond returns. This is what we like. Second step, know where you stand. Just like you wouldn't build a house without checking the foundation, building a strong financial future starts with understanding what you're working with. Your foundation is your current financial state. So here's how to understand your money. Your net worth is the ultimate measure of your financial health. It's super simple to calculate. You just subtract your assets with your liabilities. Assets are what you own, and liabilities are what you owe. Assets can be things like cash in bank accounts, investments, real estate, or other valuables. Liabilities can be things like credit card debt, student loans, car loans, mortgage, and personal loans. So let's say you have $50,000 in assets and $20,000 in liabilities. Your net worth would be $30,000. Next, start tracking your income and expenses. It's simple. List all your income sources and all your expenses. Make sure that when you subtract the expenses from your income, the result stays positive. Third step, emergency fund. Let's say someday your manager fires you or you have to pay for some medical operation. In this case, you need to have some money aside. That's what building an emergency fund is for. This begs the question, how much should you save? Should you save for 12 months or 3 months? This is personal preference, but at the very least, save 1 month's worth of expenses to buy yourself time and get back on your feet. Ideally, aim for 3 to 6 months, and if your job is unstable or you have dependents to worry about, 6 to 12 months is even better. Your emergency fund should obviously cover all of your monthly expenses, meaning rent, light, car payments, groceries, and so on. However, won't your money lose value sitting in a savings account? Yes, inflation eats away at savings. However, we can outpace inflation by using a high-yield savings account. While average inflation is 3.5%, many HISAs beat this rate and keep your emergency fund growing. Here are 10 different high-yield saving accounts that would practically guarantee you a higher rate than 3.5%. So, how much should you put aside each month? The 50-30-20 rule makes it simple. 50% are for your needs, meaning rent, food, and bills. 30% are for your wants, meaning entertainment, travel, and hobbies. 20% are for savings and investments, meaning your emergency fund, your retirement, or your investments. And just an aside, let me give you a little life advice. Avoid bad debt. It's a financial black hole. High interest credit cards, payday loans, and personal loans will trap you in a cycle of financial stress. If you have high interest debt, pay it off ASAP, even before building an emergency fund. However, even if you save and invest wisely, one major accident can wipe out everything if you're not protected. Medical bills are the #1 cause of bankruptcy in America. Protect yourself with health insurance, car insurance, renters and home insurance, and disability and life insurance. Even billionaires have insurance, because financial security isn't just about making money, it's about keeping it. Fourth step, investing. Once we are finally in a financially healthy and good position, because we changed our mindset, evaluated our net worth, built an emergency fund, and got rid of bad debt, we can finally start with investing. Now, we can finally earn the fruits of our hard work and let our money work for us. Or to put it in the words of Anakin Skywalker,
this is where the fun begins.
The first thing you need to understand is the power of compound interest. Just look at this chart right here. If you invest $10,000 with a 7% annual return, after 10 years, your money has merely doubled. But after 30 years, you have $76,122. You have over 7x'd your investment in just 3 decades. Which means the earlier you start, the more time your money has to grow. But where should I put my money in? I believe it boils down to 4 decisions: stock market, real estate, bonds, and alternative investments. To put it simple, I'm going to shortly explain the pros and cons about each of them very quickly. Stocks have a high risk level with a high return potential, low capital requirement, and high liquidity. Real estate have a medium risk level with a medium to high return potential with a high capital requirement and a low liquidity. Bonds have a low risk level, a low to medium return potential, medium capital requirement, and medium liquidity. And alternative investments like crypto have very high risk levels, very high return potential, low capital requirements, and high liquidity. So now that we know all the categories of financial assets, what should we invest in? There are different strategies out there. There is a minimal effort strategy where you invest a fixed amount of money every month into the S&P 500, for example, and you just let your money grow. And if we look at this chart right here, it is very profitable. It's also what experts recommend for the average person. But if you would like to devote more energy into it, which statistically speaking you shouldn't, since only 3% of day traders make money in the long run, you can certainly go for value or growth investing. Value investing is buying assets that do not reflect the intrinsic value, meaning that value investors short overpriced assets and buy underpriced assets. But then again, how would you determine that? And with you, I don't mean the hedge fund manager with tens of millions of dollars in the bank that hires 74 math geniuses to comb through terabytes of data. I mean you. Normal, everyday working men or women with probably not a lot of time and resources. Growth investing is relatively similar. Growth investors simply scour through hundreds of companies and invest in companies they think will make money. They do this like 50 times, and 45 out of 50 times they lose money, but they make more money with those 5 other companies so that there's still a profit. Now you probably know why experts recommend just investing in the S&P 500. However, if you found any of this interesting at all, please let me know in the comments if I should make a video about investing strategies. With that being said, please pick for yourself what you would like to do, if it's safely making money consistently or betting your life savings on illegal dog races. I'm not responsible for your financial decisions. 5th step, protecting your wealth. If you have invested wisely over time or won the illegal dog race, you now probably have a lot of money. Congratulations. What's next? You need to protect your wealth. If you haven't already, diversify your investments. We could dive into complex portfolio theory, but let's be real. That would just make this video longer and probably put you to sleep. So here's a quick example. 50% should go into stocks, 20% should go into real estate, 15% should go into bonds, 10% in alternative investments, and 5% into cash. Now that you've built your fortune, you need to keep it safe. If you own rental properties, consider an LLC, a limited liability company, to protect your personal assets from lawsuits. Also, cyber threats are real. Use strong passwords and a two-factor authentication to secure your accounts. Another important thing to do is minimize taxes. You can use a 401k or an IRA to enjoy tax benefits. If we consider a yearly return of 7%, investing $6,500 a year in a Roth IRA for over 30 years will equal to over $1 million tax-free once you retire. Another tip is to hold your investments for at least 1 year before selling. If you sell an asset within a year, your profit is taxed as ordinary income, which could be a much higher rate. However, if you hold it for over a year, it's taxed as a long-term capital gain, which has a lower tax rate depending on your income. Thank you guys so much for watching. If you have enjoyed the content, please like and subscribe. And if you want something explained in more detail, please drop a comment down below and I'll make a video about it.